Hi everyone, thank you for tuning in on time. We'll be starting in a couple of minutes, so sit back and relax and we will speak to you soon. A very good evening, everybody. Welcome to the live webinar on the Nikkei 225's record run, How Much Has Changed. I'm Ming Hui from Flip Nova, and if you were here the previous time we spoke about the Japan market, you will recognize our speaker tonight. Speaking to us will be Mr. Mooris from Informa Global Markets. And before I pass the time to him, please be reminded that if you have any questions throughout the course of the webinar, you can drop them into the questions box and we will address them during the live Q&A session towards the end. And now, without further ado, over to you, Mooris.
Thanks, Ming Hui. Give me a moment to set it up. Okay, that should work. Good evening, everyone. Thanks for taking the time out for this discussion. I guess it's a discussion because you can drop questions in anytime. Doesn't have to be directly related to the topic. That's fine. So, quick introduction to myself. My name is Mooris from Informa Global Markets. On a day-to-day basis, I'm what some people call a bulletier. We look at bond markets, in particular Japanese, Australian, New Zealand bonds. Nowadays, what that means is you have to look at a lot of central bank policy as well. So you can see that with any headlines to do with Japan nowadays, you can't really escape from a commentary on the Bank of Japan. So I know enough about it to at least give some commentary on it. So to begin with, we are looking at a Nikkei 225's record run. Obviously now it's a little bit, hold on. Let me just change my screen to the other one. There, should work now. Okay. So where I was so we were looking at the Nikkei 225. Obviously, it's a little bit off its highs now, but you're talking about, what are we looking at? We are looking at the Nikkei at 40,000, and where is that? That is past the previous high, which was back in '89. And the significant thing about that is, we're talking about 40,000. That's the bubble era high. So that's not the scope, so much the scope of today's discussion, but obviously when you're talking about whatever security you're looking at, if it's at levels that used to be a bubble when it was in a bubble, then obviously you want to know how much has changed since then. Hence the topic of today's discussion as well. So our similarities in the charts, grounded in reality. So the big question you have to ask yourself is, what things have changed since the last time we have been looking at the Nikkei 225. So some key events, throughout these periods. So on the right side of the chart, you're looking at the Bank of Japan so-called reflating the economy. You're talking about zero interest rates, negative interest rates. It's very significant events, and obviously I'm gonna talk about those and how it links to where stocks are now. But to begin with, just some very simple warm-up kind of things, valuations for Nikkei 225. So Nikkei 225 being obviously just 225 stocks, not necessarily the largest by market cap or by some other metrics. There's a selection process to it. So there are some stocks outside of the top 500 by market cap as well. So it's a fairly mixed bag of stocks. It's not so tech heavy, not as tech heavy as what you see in S&P 500. The top picks, which is a broader set of Japanese stocks, now that one's more tech heavy. So Nikkei 225 itself, immediately what you see from the ratios is that price to book, price to sales, things like that, nothing too alarming there, particularly for price to book, because you're seeing it is actually around the levels you used to see pre-pandemic. So it's nothing too alarming there. So again, back to the question of now Nikkei 225 is back to bubble era highs. How are some of these valuation ratios looking? So looking at the PE ratio, so this is the Nikkei versus the topics. You can see that PEs wise, Nikkei is actually a little bit above the pre-pandemic trend. So this chart goes from left to right, 2014 to present day. So that's a 10-year chart. Obviously, the little or rather big bump you see in the middle and valuations wise, that's your easy monetary policy from all the central banks coordinated together, kind of pushing up a lot of valuations, and also with a low base of comparison. So, should you read too much into this bump in the middle? Not so, and that applies across most stock markets as well. So nothing too controversial there. We will talk about the topics a little bit more later, because in the end, people are kind of looking, which is better. I wouldn't say a security to buy. Obviously, you can't buy it, but ETFs perhaps. But you're looking for more, how you say, a better opportunity entry point, if you like, things like that. So you can see that the topics may be interesting because we're looking that it's actually still below that kind of trend line there. So if we look a little bit more internationally, the Nikkei 225 is kind of running away from its peers a bit. What do I mean? PE ratio wise, compared to the pre-pandemic period, you're seeing that Nikkei 225's PE is getting a bit out of hand. That's how I would put it. So actually, if you look at this period here on the right side, where it is starting to kind of rise above the trend line again from middle of 2023, that is around the time there was extra buying interest from international community, if you like, mainstream media, if you have to use that word. That was end March 2023, when there was a lot of interest after Warren Buffett mentioned it. He bought a couple of trading houses. He thinks that the themes of corporate governance, things like that, makes Japan a very interesting buy. And then he went in to buy some of the names after some research. So obviously there's a lot more at play there, because once he says that he's going to buy something, then there's a whole swarm of people who follow him, because there's a philosophy of he doesn't really buy international stocks, right? So when he does do it, there's something there. So you're seeing that kind of interest help the P ratio kind of run away from the S&P, which very famously ran all the way to 30 plus during the pandemic era. Not a bubble, definitely, but the valuations were pretty high back then, and it's also beating European stocks. Obviously, European stocks are a bit of trouble. So we look at ETFs, and there's a point I'd like to make a couple of slides down. So starting with ETFs. So obviously you can't buy the index itself, so ETFs are the way to go. These are not, first thing first, these are not ETFs that are tracking the Nikkei itself. So if you look at available Japanese ETFs, they are not as, not that many of them are that accessible to everyone. So these, you can buy quite easily with most of the brokers you can get in Singapore, for instance. But the thing is, for these ETFs, they have different strategies, and it matters. As you can see in the weightage wise for these two, while they are not in the Nikkei, iShares itself is the highest by volume, if I'm not mistaken. So they come in different shapes, different sizes, different flavors, if you like, so it's not necessarily the case where big market cap, or some high valuation somewhere, then it's included in the ETFs and everyone launches the same kind of ETFs. That's not so much the case. So if we look at, say, what I showed on the left just now, which is the Wisdom Tree ETF, there's a point I like to make here, which is, Japanese stocks are going up against all-time highs. So naturally, what you're seeing is that ETFs tracking Japanese stocks are generally higher, right? So that's a no-brainer. But the bigger point I'd like to make, and let me take some time to go through this chart, is so what this is red line, blue line. Red line is the ETF I showed on the right just now. You may remember iShares one by BlackRock. That's the highest by volume. So it's on an unhedged basis, and Wisdom Tree Japan hedged. Obviously, it's hedged in that sense. It's in the name. So if you look at that, you can see that one is delivering much lower returns than the other. And what's the key theme behind that? And that's actually the yen. So Japan as an investment team, Nikkei as an investment team, that's all great. But now, in a way, and part of the reason why I'm here, I guess, is that you can't really be a equities trader and look at valuations, look at ratios, look at all that kind of thing, look at corporate governance without looking at the macro stuff, central banks, monetary policy, to some extent fiscal policy, things like that. Because this, in terms of the yen affecting your returns on some of these products, is purely to do with politics, geopolitics, fiscal policy, and most importantly, monetary policy, I'd say. Not only that of the Japanese. So if I were to pull up a simple table, this is not exhaustive by any means, right? But some ETFs here, you'll notice that the top 5 I have on this, and I'm not pulling them up in kind of like just picking it in that sense, but you'll notice that the top 5 are actually hedged. Obviously so, because the yen, the fall in the yen will eaten away at your returns. So you'll notice that MSCI Japan ETF iShares one is somewhere down 1, 2, 3, 5, 6, 7, 8, 9, 10. It's a 10th place, higher volume than the Wisdom Tree one, but obviously you're seeing at looking at a 5% return, which can't beat even the US very low cost ETFs at its current levels. So the broader point to be made here is that to some extent, while you are looking at an investment in, say, individual Japanese stock, that's great. You do your research, things like that. But definitely, if you're buying something to do with the index, the broader index like the Nikkei, you're looking at, you have to look at the broader trends that are affecting things like, the yen, and there are other things as well. So we'll go into that. So on the topic of the yen, we take a quick look at the, what's next for the BOJ. Keeping in mind that's $1 million question. Definitely, I'm not saying that I know or what I'm about to say is definitely what will happen. But there's a whole host of things that's being speculated upon right now, even this morning. So which I'm not going to go into, but you can ask a question about that if you like. So rate hikes, reductions in monthly bond buys, sale of the ETF and J-REIT holdings. So there's a lot of things that leaves room for speculation, but we're not going to talk about those kinds of things that much today. So what happened recently? End of negative rates. You're talking about end of negative rates in March. So that was a pretty landmark meeting. The details are here. Zero interest rate policy started quite long ago. Negative interest rate, which is for the more modern monetary policy era, I would define that as the period we're in since the great financial crisis, because that was just unlimited stimulus from all over the world. So negative interest rate policy started in 2016, and that experiment has ended long after the ECB own negative interest rate experiment as of March 2024. So one thing I'll call your attention to for this chart is bottom right. That is actually that is actually the scale of the kind of interest rate hike that you saw back in March. So obviously there's a lot of headlines about it. There's a lot of talk about it. There's a lot of saying, yen's going to fly after the commentary before the meeting. I think I came across quite a few that said yen would fly after the meeting. So I think why we haven't really seen that happen, because yen is down, is one of the reasons is that scale of that move. It's just that little squiggle there, as the New Zealand Central Bank will probably call it. It's just really just a squiggle. So what is the potential for that squiggle? Like, where is it going to go? Is it going to go as high as we saw back in the 90s, 80s? Not likely. In fact, it's not good. We don't really expect it to go much higher, and that goes some way to explaining where the yen is now, perhaps. So taking a quick look at economic data and how the economic data is relevant is how far that squiggle goes, higher, longer, stays there, goes back down, very unlikely. How much interest rates rise or are held or lowered, again, unlikely, really depends a lot on economic data. So we can't run away from it. Let's take a quick look at it. So core CPI itself. So there's core CPI, there's core, which is strips out energy, and then there's your headline CPI. So core CPI itself strips out food, right? And it's pretty encouraging, I'd say, to some extent. We spent 25 months at or above 2%. And this chart goes all the way back to 1975. You can see the last period it was spent that long at those levels is 1989 to 1992, which interestingly is actually the bubble period, or the bursting of the bubble period rather. So the inflation of the bubble obviously was before that, and then the bursting of the bubble period. Now, I'm not saying that this is directly comparable and that we're going through a bubble now. That's not what I'm saying at all. But what I'm saying is that in terms of the staying power of inflation, is it going to roll on? And the nature of this kind of inflation reading is, you have to get a few months of it going, then you can really take a good look at where it's going. And why is that? Because it's year-on-year change, and there's a lot of seasonal effects as well. So it's not that clear a read, but definitely you're seeing that it's the best it's been in at least 30 years in terms of getting Japan out of inflation. So that out of the way, we look at the others. So we look at inflation expectations. So inflation itself is pretty, and you can't talk about Japan now, like at least for the last 10 years without talking about inflation, right? So inflation itself, what is it? It's really about a culture of, or a mindset, or speculation, if you like. And what do I mean? It's about, I think that prices are going to rise elsewhere. Therefore, I increase my prices if I'm a producer somehow, for example. So it's a whole chain where everyone thinks, so you're going to increase price, you're going to increase price, I'm going to increase price, my produced prices are going to increase, so everybody increases. So that's why inflation expectations are great, because you see what people are kind of second guessing each other to do. So across the 1, 3, and 5-year horizon, you see that manufacturers in Japan, large being past a certain company size in terms of the value of the company. So for large manufacturers, it's pretty consistent, and you can see the last 10 years has never been that good. In fact, it's been kind of flat to negative. So they do see inflation as sticking around, so to speak. But of course, one caveat to this is that for Japan, same as Singapore, a lot of it's imported inflation. So they can see what's going on outside, and that's to do with things like yen weakness, which wasn't so much a theme earlier in the cycle, but now it definitely is. And that could feed into and create some noise in the data here. But as you can see, again, this is the best it's been in several years. So for non-manufacturers, pretty much the same. And this is the cause of a lot of turmoil in to our south, which is Australia and New Zealand, services price inflation. And to a lesser extent in, say, the US or even Europe, definitely not Europe. But for Japan, you can see that what I call your attention to for non-manufacturers is that you can see the 1-year horizon inflation expectations is actually already touching 2%. So that's, I wouldn't call it a worrying sign, far from it, but definitely you're talking about many things increasingly are kind of on the wire. And what do I mean by on the wire? Whether the data really backs up a rate hike or not, which in turn affects the yen, which in turn affects Japanese equities. So that's the point. So cash earnings, so real wages, right? It's spent 25 months now in negative territory, and this has a direct effect on what the BOJ is trying to do. And just keep this data point in mind, and we'll just carry on there. So for wage awards, what I'm talking about is perhaps the more popular name in media, which you'll see the Shunto spring wage negotiations. So largest in 30 years. It hasn't really fed into the data yet. It's starting to, which is why you see that actually the last print for this one was negative 0.7%. is kind of filtering its way through into the economy now. But of course, there's a couple of things that are slowing that, which I'll get into in the next slide. So quick one is that this year's so-called confirm is just a survey of the, so it's a sample of the overall population of large companies. But you're looking at the highest pay gains seen in 30 years, and that's kind of a trend that you can see forming there, 2.27 or 2.3% in 2022. So 2.3, then the following year is 3.9, and the following year is 5.6. Can it go much higher? I'm not too sure, but that is probably determined a lot by corporate profits, which is we probably touch on that later on in the presentation. So with one thing I'll highlight for wage gains, and some of you probably already know this, is that for the Shunto wage negotiations, workers at large companies only make up 30% roughly of the whole Japanese population. The other 70% of the working age population, that is, actually they aren't covered by those kind of wage gains. So it's some of them are unionized, some of them are not, but in general, a lot of them just depend on the efforts of smaller unions with less bargaining power, or just really the charity out of the employers they run with. But anecdotally being reporters talking to unions and reporters talking to smaller companies, actually it seems to be the case that many small companies have actually done quite okay during this period. And what I mean by quite okay is that they've actually earned a decent amount. They're not struggling that much. That they have to close down and things like that. And how that helps is that with that kind of corporate profits they have, they pass that on into paying workers and in giving them wage increases. Now, why would they give wage increases? If you're an employer, why would you increase somebody's salary for no reason? And a lot of that is actually pretty interesting. There's many reasons for it, but one of the bigger reasons that will jump out if you look into it is that actually you're seeing that they're having to do it to retain these workers. Otherwise, they'll just run away to the cities or run away to the MNCs and larger companies, or even overseas. So there's that incentive, and you'll find that there's a common case if you look into Japanese data, that there's a labor shortage, and this shouldn't be a surprise to actually most economies even with that demographic. I mean, Singapore has its own labor shortages in certain industries. So the signs are pointing to large companies, small companies, both are going to raise wages by enough, and that will overcome to some extent this chart, worry around that chart at least. And that goes into what the BUJ talks about as a virtuous cycle, which is companies earn more, companies increase wages, employees with more wages spend more. The increased demand increases inflation, and therefore that's a virtuous cycle. So other data points I'll talk about is that is a fairly simple one, and it's just this, it's simple but two-sided. Japan's economic recovery, it has to happen for the Bank of Japan to justify raising interest rates or tightening monetary policy to some degree, but definitely raising interest rates. So what makes up economic growth? Part of it is domestic consumption, part of it is things like government spending, another part is kind of your exports, so your industrial production, things like that, right? So for domestic consumption, right, you can see that it's not bad, particularly retail sales. If you look at the bottom, so retail sales is above that line I've drawn. So that line, the black line there, is actually the 0% line year, right? So it's not that bad. It's not as bad as what you see for real household spending, which is very negative, or at least it's stayed negative over a year. Only recently it's broken above a little bit. But what we're seeing clearly is that it's not convincing. So on the domestic consumption front, a lot more needs to be done. So Japan's one is not that bad, not as bad as what you see in, for instance, Australia, which is Australia's population is increasing, but their retail sales are flat, which is, that means on a per capita basis, that's actually negative. So at least for Japan, it's not that bad, I would say. So if that's the consumption side of the equation, then we look at the export side. So export side is a lot has been said about exports actually being the thing powering the economy forward. Industrial production being part of that as well. So what I'll highlight is that industrial production, the data is a bit noisy for 2024. Otherwise, it's a kind of retaining the bump it saw in 2021 decently well. So what I mean by the 2024 kind of noisy data is that you're talking about to a smaller extent, the Noto Peninsula earthquake. So there's a New Year's Day earthquake. Not so much a big factor, but industrial production data, when you part of that component is actually automobiles, and there's an ongoing list of scandals. I think recently there was another one with Toyota as well. So for Daihatsu in January, for instance, it resulted in a factory halt, which impacted even GDP for that quarter. So it was that data there is a bit noisy, but the point is, if you were to weigh the two sides of the equation, or they are on the same side perhaps, but so if you look at these two factors that contribute to GDP, that's a better way to put it perhaps. Domestic consumption is still very lackluster. It may pick up if wage gains pick up, and that's what the Bank of Japan is counting on. Industrial production, exports, things like that, it's kind of sustaining itself in a way, but there are factors there which I will go into a little bit more in the presentation. So stocks itself, if you look at Japanese stocks, a key feature of Japanese stocks, and I think what you see in a lot of commentary for Japanese stocks is that weaker yen is generally good for some stocks in the whatever benchmarks you're looking at. So they will call them export focused. So obviously those are like your Nikkei. For Nikkei, it's like your automobiles, things like that. That will see increased demand plausibly if yen goes down. So how long will it last? So again, that's the key question I'm asking. So it goes in a chain like this. Where's the economic data at now? And is it enough to convince the Bank of Japan? And that will affect the yen, which in turn, as you can see how closely the lines are hugging each other, except during the periods of crisis, obviously. And if you can see that, if you have a view on the yen, so two things I've already mentioned here. If you have a view on the yen, it directly correlates to stocks. And if you have a view on the yen, it will also affect what kind of securities you look to buy. If you recall the example of hedge versus unhedged. A quick note about hedge unhedged, which I didn't mention, is there's usually some tax requirements there as well. So you got to be a bit wary of that eating into your gains. Expense ratios wise, yeah, pretty okay, I'd say. Can't beat the US, but it's still pretty okay. But so dollar yen itself. So now we delve in the dollar yen territory. So dollar yen, I'd say that the recent struggle with dollar yen and 160. So it's already broken 160 from a technical analysis standpoint. It's broken it, right? Will it sustain that move higher? That's up in the air. That's $1 million question. But 160 itself is a decently significant level. What do I mean? It's actually stayed below 160 for that long, and it's been fairly consistent. And that actually just matches the bursting of or rather the inflation of the asset bubble that you saw at the late 80s, and the bursting of the bubble, which went all the way into the early 90s. And then, dollar yen has never been above 160 since then. So of course, part of the factors for that is actually, or rather, part of what started the inflation of the bubble and things like that. I'm not going to go into those into too much detail, but Plaza Accord, Louvre Accord, Louvre Accord being the accord signed after the Plaza Accord to stop the volatility after the Plaza Accord, partially successful, I'd say. So what is the Plaza Accord? Plaza Accord itself was, as you can see, is related to countries with the dollar looking to appreciate the dollar against everything else, because obviously you can see that dollar yen past the left side of the Plaza Accord, the dollar yen was actually all the way in 350 even. 300, 350, which is a ridiculous number to think about if you were born in the 90s or 2000s, like. But in the 90s, that is. But it's a pretty high number to think about, and people are screaming so much about 160 being kind of line in the sand. 1 year ago it was 150, and 300 is kind of unthinkable. But the point is, there were major events that we can point to that kind of catalyze all this. So from the Plaza Accord, you're talking about people being made to buy dollars that didn't work so well. Then there's the asset bubble that came in, and that had a lot to do, in my opinion, and I feel like it's partially opinion-based, partially evidence-based. It's about window guidance. You can look into that if you like. That could be a whole other presentation. But basically, a lot of it has to do with the inflation on the asset bubble for dollar yen. And for where it's headed next is so yield spreads wise, how do you look at this chart? So pay attention to the red line, which is, as long as that red line is above 0, is technically more attractive to buy the dollar. Obviously, you're not accounting for other things like your hedging costs, things like that. But what you're seeing is that usually the common wisdom is if your yield spread, which is the red line, goes higher, it should be more attractive for me to buy a dollar, right? I sell yen, buy dollar, whatever it is. And correspondingly, there's that kind of implication for your Japanese investments as well. So if it goes higher, blue line is supposed to go higher. If it goes slower, blue line also goes lower. You can see that this relationship hasn't really held up all that well through some periods. And what are these periods? In general, these periods are actually periods of geopolitical instability. So some of them being like, for the left side, that's the inflation of the asset bubble. That's the big box here. And then there's your popping of the asset bubble. And then there's your start of the lost decades, which is the middle of the 90s. I think multiple headlines about it. It's just, what's happening in the economy, why can't we rescue it? Looking at the 2000s, you're looking at the asset bubble in the US. And there was the tail end of Asian financial crisis, although not much to do with that here. This is the great financial crisis towards the middle, and on the right, obviously, there's COVID. So during periods of geopolitical uncertainty, you can see this relationship start to break down. And what is the larger point I'm trying to make here? The larger point is that currently people look at the dollar yen chart, and I think a lot of the analysis that we are fed quite easily, or is more easily available to us, is that we don't think the red line is going to come down anytime soon. Therefore, the blue line is just going to follow the red line higher, being yield spreads are not going to come down anytime soon because Fed's not going to move much, or at least not going to cut by as much as expected and as early as expected. And then the Bank of Japan, that squiggly line you recall I mentioned at the beginning, that squiggly line, which is the interest rate hikes from the Bank of Japan, aren't going to be too much. So the red line doesn't go much higher, or doesn't go much, doesn't reverse course and go lower, which is the yield spread narrows, then do you expect the blue line kind of and the red line, which is dollar yen, as well as the yield spread, to kind of go sideways or higher? So there's a lot of the easily available analysis out there, but many a time this relationship has broken down during a period of stress, some sort of crisis, some sort of event. And I think anyone who reads anything nowadays with an internet connection will tell you that nowadays is just full of geopolitical this, geopolitical that. So I'm not suggesting that relationship right at the end, you see that, you're going to see that widen, the blue line and the red line, which is dollar yen and the yield spread, but the risks are high. That's all I'm saying. So real yields itself, right? That being said, is there any reason to have optimism that the yen is going to reverse its decline? Which is to say, what's the implication for Japanese stocks if it reverses its decline? Exporters, starting with exporters, and then Japanese stocks in general, you're going to see kind of downward pressure on their prices, because weak yen, strong stocks, strong yen, weak stocks, so to speak, at least particularly for the larger caps. So real yields, you see they're negative there for 10-year JGBs. It's not that attractive. US Japan 10-year yield spread, it's still kind of high, so no one's really going to touch that. So where is the yield gap going to go? I think up to now, it provides one of the more convincing reasons or the convincing factors that explains dollar yen movements. As you can see, that red line, which is the yield gap versus dollar yen, it tracks the moves quite closely. Obviously, recently, that move has diverged a lot, more so than you've seen at other points in at least over the last year. So I wouldn't say, there's kind of, they're going to diverge even further, it's going to go very far, but definitely I'd say the takeaway for me at least is that any assumption that dollar yen is going to bust right through 160 when the Bank of Japan announces, let's say, uh, next meeting in July, a lot of people now are speculating that they're going to raise rates and reduce bond buys. If it's disappointing, then you're going to see dollar yen bust through 160 and fly to who knows where, 200, 300, wherever it is. All I'm saying is these relationships don't really hold up in special periods. And there's a lot of reason to be very cautious about those kind of analyses. So yen is a driving factor for Japanese stocks. Two things for me at least. Yen is a driving factor for Japanese stocks, not a given in the coming periods, in my opinion. I'm not saying that yen's going to appreciate. Ultimately, when you look at certain charts, overwhelmingly pressure is down for the yen, which is dollar yen up. The second thing is implications for your investments. If you have something that's unhedged in a yen, and I think this was quite a popular theme for the more professional side. You're talking about your big Japanese players, which is your life insurers and pension funds. Their commentary is widely available. In term, they give their what we call the investment intentions twice a year. So the last one came out like 2-3 months ago. So why is that significant? So I think you see a lot of professional managers of investments, right? What did they assume? They assume that because dollar yen's that low, I'm not saying all of them were like that, but definitely this was quite a theme. Dollar yen was quite low. They don't really think it's going to go that much lower, especially since Bank of Japan is expected to tighten monetary policy. Therefore, I'm going to buy unhedged because I think the yen's going to appreciate. So that's something you got to think about. Even if you are kind of a more safe investor, if you're a safer investor, you just want hedge, you don't really care. But if you want, how to say, even if you're a safer investor, you look at the dollar yen chart and go like, 160 is kind of high. I don't think it's going to go much higher, and then you buy it unhedged. It's a whole other thing. And then if you're a more speculative sort, then that's kind of like double the risk you're taking. One is where is the security itself going to go, and the other one is, what's dollar yen going to do to my investment. So that's something to keep in mind in the coming period, at least for these kind of stocks. So at least my takeaway from looking at this, and I was speaking to someone in came from one of the China asset management companies recently, is that his takeaway after looking at something like this is that is his clients' portfolios, or people's portfolios in general, kind of aware or ready for a possible life of dollar yen 160 again? I'd say, it's a complicated question. Definitely, the answer or the kind of suggestions I can give is out of scope for this discussion. But what I'd say is, whatever you read nowadays with regards to dollar yen, right, it's not a given that it's going to go higher, in my opinion. So real quick about FX intervention itself, right? So the point I like to make about the recent set of intervention is that, right, it's not suspected, but it was confirmed. So these are 3 arrows there pointing to the 3 interventions, okay? So there's the set which I'll lump together as one, September and October, and then there's the one which happened quite recently, which is, March, April, May. So that period of time, what you're seeing is actually intervention. The takeaway is that intervention didn't really, wasn't able to reverse the move in dollar yen higher, which is to say, it wasn't able to encourage the yen to rally. So what is significant about the observations here? So, if you look at the history of intervention, or you look at the point of intervention, right? Point being, why do you intervene and all? I think when people hear the word intervention, or when people talk about the word intervention very casually, right? The assumption is that you want to stop that move, whatever move you're going. If you're going higher, you're going to stop that. If you're going lower, you're going to stop that. But I think people are coming around to the idea that the policymakers now, so usually is the thinking at the Ministry of Finance, right? They are not so much looking at reversing the move higher. So they're not looking at reversing the move higher in dollar yen, and it comes all the way back down to 120, 110, 100. I think the thinking now is coming around more to, they just don't want it to be that volatile. They don't want it to trade more like more EM currency, among other things. But they don't really, personally, they don't really see any factor that can stop yen decline. So intervention wise, you are seeing that, while there were very sharp moves that we saw at the last intervention in 2022, the one before this year's one, because people are still finding their feet, what's the intent of policymakers in terms of are they trying to reverse the yen decline back to pre-pandemic levels, or what are they trying to do? I think opinion there has kind of moved though. They are okay with the yen actually depreciating, just not that much in a day or a week or a month. If you follow what the Ministry of Finance guys say, what they're looking at is a 10 yen move within a month. That is the loose guideline. So if you have a 1 month chart of dollar yen open, you're looking at that and you see that from the bottom to the top, or at least the whole range itself is making a 10 yen move, then generally that's when most people will be on alert for FX intervention. Also, there's a point on sterilization, but a real quick one, it's something they do to maintain a monetary base for monetary policy reasons. But the side effect is that so MOF conducts or orders FX intervention, BOJ conducts it. BOJ conducts it at the same time they do FX intervention to make sure the monetary policy objectives are met. So there's evidence to show that they've been doing this a long time, and that always blunts the impact of FX intervention. Interesting thing to me now is that since March, now that they have kind of scrapped the two named policies, which is yield curve control, negative interest rate policy, they don't really have that much of need to actually conduct sterilization. But I'll be looking out at least for the data for that. What I expect to see is, for the September, October intervention here, I would have expected to see that the line not be flat, the blue line not be flat. It has to shift in some way depending on what direction the sterilization is going, but it didn't. So clearly, there was some sterilization there. So that's that for the yen and the impact on stocks. So yen, BOJ, and at least my view on how it relates to stocks. So what I'd like to talk about next is actually the geopolitical element. So geopolitics itself, it may be a bit hard to kind of talk about, but I will try. And without giving away any personal bias, because I know now it's kind of a fraught period, if you like, is that protectionism, left or right, whatever it is, interestingly, so I took this graphic off of CNBC for Trump and Biden's hit. They put Trump on the left and Biden on the right, which I think is a mistake. But otherwise, you're looking at two sides of the same coin. Obviously, they're not exactly the same, but the theme is the same. And what do I mean by the theme? When Trump was president, on the left, you talk about trade war, you talk about currency manipulation, and who is the target? Everyone, essentially everyone. So some are more serious than others, obviously. So you actually do have kind of some sort of trade measures that were imposed on China. Less so, of course, on Japan, because you have probably had a few more layers to go through. But then you look at Biden, right? So the target's not really Japan at present, it's China. But what I'd say about that is actually it's not that difficult to imagine the so-called, if you like, tariff guns being trained on Japan in the medium term. So medium term, usually you're looking at like 2 to 5 years, something like that. And what do I mean by that? And this is what an interesting topic to me, which is Japan Inc. Okay, so Japan Inc. What I'd say about this and what the slide says, it has survived well into the modern day. So I understand this is not an interactive kind of session, but if I would ask the question to a kind of sit-in audience, the question I'd ask is, can you guess which of these companies actually existed before World War II? Okay, so obviously these are Japanese companies. And when I say existed, it could have come from another different company, for instance. And the answer, I mean, there's nobody to ask, but I'll give you the answer right now. And that red box is not actually just Honda. Honda is the only company that didn't exist before World War II. All others did in some form. And what is the point I'm trying to make here? Japan Inc. What do people mean when they say Japan Inc.? They mean they are talking about a very deep-rooted culture. And what is a culture? So this is outside the scope of finance, but culture is kind of, you look at a Japanese person, you look at the Japanese product, you look at the Japanese building, whatever it is, right? You know it's Japanese. Okay, to some degree. You know the word culture, the way they speak, the way they carry themselves, the Japanese or Singaporean or, any country like. But for Japan itself, it's a very distinct culture because it's just so unique. And what I mean by that is, so Japan Inc. or Japanese culture itself, obviously there's a lot of things that you can focus on, but how I would actually define it is, they during the industrialization period ahead of World War II, where Japan took over Manchuria and things like that, you can read up about it. There was a lot of emphasis on industrialization, and what came from that? It came a very sort of aggressive, not militarily so, but corporate aggressive kind of strategies. What I mean, uh, competing on price, workers' rights. I mean, not as bad as what you see some other parts of the world, but you're talking about a very structured, hierarchical structure where you have an idea, or let's say your boss says something that that you don't really agree with, then you gotta sit him down for 20 minutes and say, can you explain to me your idea? If not, not gonna do it. That's not so much the case. So that is a kind of culture they've bred for themselves, and it's a very how some commenters would actually describe as a warlike culture. So they really go all out for market share and they compete on price, and because that's the most obviously we as consumers or just observers, you don't see what happens in the boardrooms, day-to-day office desks, whatever it is. But what do we see? We see the price tag on the products they put. It is aggressive, and you can see it all the way from the end of World War II when they reindustrialized. Thanks very much so to American money for that, and geopolitics. You have geopolitics to thank for that. But after they got back on their feet after World War II, it was really all about price. Produce as much as we can, cover as much ground as we can. We don't care if we make a loss sometimes. I'll use other parts of the business to cover it. It's go out, expand as fast as you can. And that is the strategy that you actually see alive and well today. And part of that culture of Japan Inc. is actually more focused on reinvesting for the future rather than returning your kind of gains to investors. And now that comes to present day, which is to say, if you bought a Japanese stock, or if you looked into Japanese corporate culture 10, 20 years or even not that long ago, which is really the modern post World War II era, there's still a lot of emphasis on reinvesting for the future. We want to grow for growth's sake, in a way. But now there's a very interesting trend, which is corporate governance, and I'll talk about that a bit later. But for growth's sake, warlike mentality, that's the takeaway at least I want to get from this slide. So therefore, what I'd like to tie two observations. One is Japan Inc. Very much so, they still have that kind of culture. They do compete on price. I think a lot of people won't debate, or maybe you have a couple of quibbles with the quality, but price for quality, you are getting value. And you're talking about pretty high value meaning, you're not buying like little plastic bric-a-bracs like you see in some producers, but you're talking about, you're buying cars, you're buying trucks, you're buying heavy machinery, you're buying a lot of things from the Japanese, and these are at prices that a lot of people cannot compete at. So Japan Inc. alive and well. Japan Inc. used to cause problems with their great ally, the US. So big reason why the US wanted Japan to actually come up, and a lot of these Japanese companies to come up, is to create one bastion in Europe, which is Germany, then the other bastion in Asia, which is Japan. Leaving out the military aspect is a lot to do with where are your US products going to go. You need a strong economy to kind of keep that whole circle going. So there's a lot of reasons, and what am I getting to here? There's a lot of reasons Japan has special treatment from the US in terms of whenever Japan kind of dumps their products somewhere, especially on the US will go, oh, that's fine. that's fine. Up to a certain breaking point, you're talking about around the 80s, and that kind of, I wouldn't say it boiled over, but definitely is very visible. So that picture here, I'm sure you've read the words on the slide already, but the picture here, you're talking about people in Congress actually smashing a Toshiba on the steps of the Capitol. So I mean that's a statement there. I want to say it's a very strong statement because in the end they are talking about House of Representatives, but uh, it's a statement nevertheless. And you're talking about during the bubble era, which is you're talking towards the late 80s, right? You're seeing a lot of high-profile Japanese buying. So two of them that's pretty interesting to me is you're talking about uh, uh, partial purchase of the Rockefeller Center. There's a typo error there, but it's a Rockefeller Center, and 7-Eleven, which actually came from Dallas, and it's pretty interesting to me. Now I don't think people would kind of associate it with anything else, but something a little bit more Asian, perhaps. So currently, you're talking about the current climate, right? Japan Inc. There's a lot of potential for friction, whoever the next president is going to be, in my opinion at least, because they got there for whatever reason. They have their own opinions, that's fine, but they have advisors, they have supporters, they have congressmen to kind of factor into their considerations. Big one we saw recently was a Nippon Steel takeover. So it kind of has echoes of this, which is Nippon Steel buying US Steel, a little bit of echoes of this here. And then Joe Biden would say that don't do it, and now they've put it off until after the election, which is quite telling what's going on there. Again, geopolitics, Japanese interests being blocked by the US, even though they are so-called getting a favored treatment over China right now. So will that fear return? So it was some time ago. It was during the lead up to the bubble era. But definitely I'll say there's a risk there. I don't think China will stop being the focus of trade restrictions in the near term, but definitely if you do believe that the Japanese economy will pick up, Japanese companies will do well, you're going to see Japanese products take a lot more prominence in the world out there where governments are becoming more protectionist. Okay, so that to me is a potential risk for Japanese stocks. So for example, for us in Singapore, one of the key things we saw was actually the TPP, which was supposed to be 12 countries in the US. I think I recall this Donald Trump's first day. He came in, he pulled out from the TPP. TPP is now TPP 11 with the where Japan was the one spearheading it, because to them free trade, they need as many destinations to export to as possible. So at least that's what's going on there. But will that kind of trade tension come back? I think it's very, very possible. So talking about currency manipulation or perceptions of that, right? What is interesting to me is that when Donald Trump was in office, yen, you're talking about at 100, 110. I was thinking it was a comfortable, consistent level. I recall whoever around me going on holiday to Japan, we were talking about Sing dollar yen was like 80. So, that's all right level. Now it's at 110. But he used to accuse them of currency manipulation in 2017 to 2019, and a big reason for that is obviously Japan exports a lot, and that means the perception of taking away American jobs, which is what Donald Trump is a lot about. So you talked about yen now is at levels which are even weaker than when he was president. His first day in office, or his first month in office, I'm very sure someone's going to pull up a chart of this to him, and I'm not too sure what he'll say, but definitely the ingredients are there. At least I think that much is clear. So in essence, if it wasn't clear enough before China, there was Japan. So sentiment towards Japan softened a lot during the lost decades. So again, that started in the early 90s to mid 90s, because people don't really see them as a threat anymore. But as we've seen, Japan Inc. is still there. It's a lot more to do with the monetary policy, the conduct of monetary policy, than anything. But if we see a resurgent Japan, definitely there's a lot of risks of this, particularly when a lot of governments are turning more protectionist. So interesting to me, silver lining perhaps, is that with a lot of geopolitical instability, one headline stood out to me recently, which is this, which is the theme here is so on the left you see 2019 IKEA. I'm told you can pronounce it whichever way you like. So IKEA, they actually moved out of the US. They moved their production facilities out of the US. They sell their stores there. That's fine, but they say production is too expensive, right? And they do the whole kind of globalization thing, which is you produce it elsewhere, maybe Mexico, wherever it is. Here they say Europe, and then they ship it to the US, and that's cheaper than producing in the US. Now on the right, barely 5 years later, and from a capex point of view, there's like no time at all. Barely 5 years later, now they're supposedly looking into creating new factories in the US again. And a big part of that is because of geopolitical concerns. And I think you're going to see that a lot more. So where does that leave us? Where people like in Japan, a lot of companies are cash rich. What are the kind of alternatives they have if they are worried about trade disruptions? They will likely have to look into creating production centers, supply chains to the production centers, which are near countries that can really consume. And how many countries nowadays can really consume? I mean, US is the perennial one. Europe's one is a bit anemic. I think Asia-Pac people will look at China, but China definitely has more capacity than consumption right now. So I think that bears looking into. On its face, they're talking about, say, how this will look like is actually you're looking a lot less at investment to Japan in that sense, but for these guys, but it makes a lot more sense for them to actually bypass the protectionist wave and trade disruptions from Red Sea attacks from the Houthis, things like that, by actually building and supplying their retail stuff, retail facilities directly where consumption is holding up, starting in the US at least. So at least that to me is pretty interesting. It's not a totally doom and gloom and everybody kind of closing their borders in a sense. So real quick, the evolution of the Japanese stock market. So tangible, what we're looking out for here is tangible changes. Maybe evolution is a bit of a strong word. Typically, you wouldn't look at more of like a hibernation, then you emerge stronger for Japan because things don't move that fast. But again, just a reminder, we are now in bubble era highs. So first thing I'll talk about here, which is you can see at the top there as well, is Bank of Japan's changing role. So Bank of Japan itself, real quick, Bank of Japan ultra loose monetary policy. You can look at it as negative rates, zero rates, whichever it is. There was what they call quantitative and qualitative monetary easing, which is unlimited money printing as a very colloquial slang. So that's the wider strategy, unlimited money printing. The formal strategy was, they flood the money, they flood the market, they buy a lot of different securities, and that's on the left here. JGBs, ETFs, commercial paper, corporate bonds, anything that can be bought, they will buy it. So ETF purchases, now that directly relates to stocks. So Bank of Japan, they bought so many ETFs that now they own, like, you're talking about anywhere between 4 to 5%, 6% of what's listed on the TSE, right? So to say that it's very big is not really the case, but to say it's small is definitely wrong. So it's a telling chart here is when they started their ETF purchases, you're looking at, firstly, it was around 450 billion yen in 2010. So onto this chart, you're talking about they started buying when the Nikkei 225 was 10K, and then now Nikkei 225 is 40K. And but the thing of note here, and immediately without looking at the slides or without having to make you look through the slides, I can tell you that last 2 to 3 years they haven't really bought much ETFs. It's all been sustained on its own momentum, as it were. So which is that in the middle. ETF and JGB purchasing ended March 2024, but they haven't really been buying it since 2020, so it doesn't really matter in that sense. So ETF purchases, what is happening now? They've bought it for the last about 10 years, because you're looking at 2010 to 2020, right? They bought it for 10 years. Now they hold a decent chunk of stocks listed on the TSE. So what are they going to do with it? Every single time Bank of Japan Governor Ueda has to speak, keep asking him about it. What are going to do with ETFs? What are going to do with ETFs? And he always has to say the same thing. We're thinking about it. So the point there is people are watching what they're going to do with it. There's been a lot of suggestions recently. One of them is to the largest pension fund in the world to actually buy it. I don't think that's that feasible, but definitely this is an area to watch where a structural factor that has contributed to a rally in the Nikkei has now been removed. They haven't been doing it for the past 4 years, but that's a bit less important than the signal it sends. There's no more adult in the room. There's no more person to turn to, because the mechanism wise, when do they buy the ETFs? If, for instance, towards the end of that period, around 2020, if the topics drops by 2% in a morning session, then they'll come in an afternoon session and then they'll buy up topics ETFs. So that's how that mechanism works. So what that usually does is it reduces volatility and puts a floor on the index, and therefore or rather the constituent stocks, and therefore the index. So it kind of ends an era, a 10-year era, if you call that an era. The silver lining there is that now Japanese stocks don't really have that kind of they can't coast along based on BOJ buying, right? So now they have to do a bit more legwork, and that legwork, some hope, comes in the form of corporate governance improvements, which is on the right and in the slides later on. So talking about shareholders and the Tokyo Stock Exchange. So shareholders now, recall when I talked about Japan Inc. and how culture-wise, they're not that used to treating shareholders well. Why? Because they want to take that money and they want to put it into their business. They want to grow their business, grow market share. It's aggressive. It's like a war, as many people would comment on the way Japanese companies are run. But if you want to be listed, if you want to raise money from people like us or people like funds, things like that, if you want to be able to do that, especially since you don't know about corporate debt markets domestically, since the Bank of Japan owns like half of the benchmark bonds. So if you want to raise money there, you have to play ball with the TSE. And the TSE has been, I wouldn't say getting their act together, but definitely they've been a lot more active. So it started off years ago, but perhaps a turning point some people are looking at is 2022. They did a move to try to consolidate categorization. The big one was perhaps the price to book ratio. If you don't hit at least one, you have to explain. Right. I mean, there's not much else they can do. It's kicking them off the index obviously is too much. But things like that. The last one there, I would say, is pretty significant as well, which is they ask Japanese companies cross shareholdings or any such structure, which is, say you have a subsidiary which is also listed. You have to declare, right? You have to declare, not only say that we're linked, and you have to declare at least to a certain level of detail how linked, right? And that actually goes quite some way. For instance, reduction in cross shareholdings, it does improve your return on equity, which actually won't go into how, but you can read up about it, which actually does go some way to improving price to book ratios. It improves the price in essence. So it's a interesting shift. They are not done yet, and I think they are in a great position to do it because Japanese assets, the yen itself, you're talking about something which is international benchmark, internationally traded. It's certainly a lot easier for them to do something like that. And I think a parallel example you can find in South Korea. They're trying to do the kind of stock value scheme. They're trying to make the Korean won traded for longer hours. They want to be launched next month. So they don't have that kind of advantages that Japanese assets have, and they're really leaning into it now. And the TSE is quite aggressive about it. So the point of those headlines there is that it attracted a lot of interest at first, especially around 2022, 2023. Now people are a bit more convinced, particularly after the Warren Buffett endorsement, and that was March 2023. So it's quite a theme now, I'd say. So takeaways wise, right, I'd say that small and medium-sized companies, which is to say the topics as compared to the Nikkei, although it's not directly calculated like that like the Nikkei is not a market cap based index, right? But the topics itself may provide something a little bit more interesting perhaps, because roughly 45% of the companies trade at price to book of less than 1. And you're looking at, for the Nikkei itself, a lot of companies have actually played catch up to get their uh, price to book above one above one, and people are sharing best practices, strategies, things like that. It's pretty entertaining stuff. Some of them, some of the leadership is actually getting tuition in my words for it, and these case studies are actually being put online to say that, look, this guy didn't know anything about how to run a listed company, in a sense, to play with your ratios, so to speak. And now he's talked to us, and then now we've managed this is a success story. So it's pretty interesting. I'd say if you can read Japanese, or if your friend reads Japanese, a lot of interesting discussion going on for Japanese stocks nowadays. And this comes from the listed company perspective. Topic itself is also still not at record highs, whereas in case, I'm not saying it's going to get to record highs. I mean, many benchmarks never do, but it's provides an interesting opportunity perhaps. So real quick, I mean, the usual headlines, which is a lot of things have improved. Left to right real quick is you're talking about how direct moves by companies to actually bring their price to book ratio up, which is great for shareholders. The middle one is you're talking about subsidiary listings and also cross shareholdings. And then for the right is you're talking about corporate action, which is beneficial for shareholders, not that common last time, which is things like stock splits. And stock splits are pretty relevant for Japan because there's a minimum lot size order, right? So if you want to buy something as an ordinary Japanese citizen and you look at the average salary or the median salary, there's no way you're going to buy some of the more popular companies unless they do a stock split. So more of the same. You're talking about board independence, accountability. Trends are pointing in the right direction. So NISA reforms, I think that's the one that's gotten a lot of buzz, I would say. Interesting to me is if you go on your usual message boards or YouTube or things like that, particularly if you do it in the Japanese language, you'll see a lot of guides. One thing you learn about or one thing you hear about for Japan now, a theme. While I think in Singapore there's a lot of things like scams, or in Japan it's even worse because you're talking about people who in a deflationary era, it's more worth for them to keep their money under the mattress rather than give it to a bank. Now they're taking their money out. They learn that they're not that savvy with the money. What happens? Scams. So it's very interesting. So if you have a question nowadays, you have internet access, what are you going to do? You're going to pour your heart out online, and that's what we are seeing, mostly in the Japanese language, of course. But so if you're only searching for it in English, you're not going to see that much. But it's pretty interesting. It's a lot of people asking about this. So what is the NISA? So NISA is kind of your scheme for one is there's a speculative element. There's a bigger one. There's a speculative account. You can buy stocks, ETFs, REITs, whatever. And then there's the more retirement-focused account, which is the safer, longer-term stuff. So under the current prime minister, they've actually tripled the limit for the retirement one, doubled the limit for the speculative one, and it's pretty popular, man. Big reason why it's so popular, at least what I'm told from some of the guys who are helping to open NISA accounts, or link to some of the guys who are really running the show, is that it's tax free. So they really like that. And you can see the headline on the left, NISA account surged by 1.6 million. That's pretty significant. And there's a lot of people who, I mean, part of it is they're looking to maximize their portfolio because they want to run away from capital gains tax. But another part of it is people have never invested before. Right. So it's pretty interesting to me. You're talking about huge sums of money. Again, they had their money elsewhere, maybe in bonds, maybe in kind of CDs, or maybe actually really under the mattress. But now they're taking it out through this government scheme, tax-free, which is pretty significant. And they are actually putting it into the stock market. As to where in the stock market, for example, a simple question: would you rather, as a Japanese, invest in Japanese stocks or US stocks? That's a whole other topic. Short answer: US stocks. But as long as some of your money flows to Japanese stocks, now that's a good thing. So Japanese households, real quick, they hold over 2.1 quadrillion yen, simplified, it's 13.5 trillion yen, dollars in assets, and roughly half of that is on the left, it's in cash. like I said, it makes more sense for you to hold it, in a deflationary environment. So here's an interesting thing to me, at least. First observation is growth in stocks and investment trusts has grown a lot. You're talking this a quarter-on-quarter kind of growth. This was the end of last year from this survey. So to me, it's pretty interesting. And the next edition is coming out pretty soon. So we'll get an update on these levels a few days time actually. So to me, it's pretty interesting, and it tells a pretty nice story, which is they are wising up, or not to say wising up, they are kind of finding it more attractive to put their money into stocks and investment trusts. And then for the last, or not the last one, but for this one here, the interesting thing to me is you see that much money in cash. That's for deflationary environment. It makes sense. If Japan, like I said, inflation's a mindset, inflation's a belief. If they believe that inflation is going to be positive, which means if I put it under the mattress, it's going to lose value, especially if the Bank of Japan raises rates and they're going to pay me to put my money in the bank, I'm not going to put it there. I mean, obviously, I'm going to put it in deposits, but a lot of that's in cash. And the thing is, in that kind of environment, right, you're also going to assume that there's a lot of other assets that will do a lot better, stocks around them. So, that 52.6%, if I were to make a call, I'd say that I think that it's going to go lower and it's going to get allocated elsewhere. So to me, that to me is pretty interesting. Obviously that 12.9% there, you're talking about a split, which I mentioned, overseas and domestic. And the problem here is that domestically, the trauma is still there. You're talking about 82% drop across an 18-year period. You think it's going to get better next year, it just gets worse. Would you have bought in at this bottom here towards 2008? It's I mean, timing. I'm not even going to get into timing the market, but to actually see Japanese households shift the money from cash into stocks and into Japanese stocks, they have to overcome this kind of trauma. As it stands, I've seen some research on it. Morningstar in particular, they did mention that the kind of split you're seeing is about maybe 1/3 domestic, 2/3 foreign. Highest preference is still for US stocks, obviously, as is the case all over the world. So that to me is pretty interesting. But definitely there's enough to go around just from this. And again, that's from NISA itself. Yep. And with that, I am done for my slides. I would say for the tangible changes for Japan, there are quite a few. If there were anything that you had to look into, I'd say NISA is a big one. Corporate governance is a bit harder to follow. Price to books, probably the ongoing effort, more to come as well. So I'd say things are looking up for Japanese stocks in general as an investment team. Yen would provide some risks depending on where it goes. I think the expectations overwhelmingly are for it to go lower, which would be supportive for stocks, but you can't be sure of that. Yeah. So right now, I'm going to take a quick look if there were any questions. There are no questions now, but I would say since I've overrun by 15 minutes and I still see the bulk of you still here, I think hopefully that little extra I put into the presentation would have given you a bit more of a broad look at the Japanese, uh, the what we're looking at when we look at Japanese stocks. So it can't be in isolation. It has to be in sequence. How's the economy doing? What's the implication for the Bank of Japan? What's the implication for the yen because of the Bank of Japan? And then how does it affect stocks? And it goes in a cycle itself. So it's I'd say definitely if you're invested in Japanese stocks now, you can't miss some of these themes. At the very least, it presents a very interesting I'd say dilemma for you. Hedge, unhedge. I'd say there's quite a lot of folks out there right now with unhedged positions because they think 160 is going to be ceiling for dollar yen. That adds a little bit of spice to their positions. It's and I'll say it's quite a viable strategy in the coming periods as well. Yeah. But with that, I am done for the evening.
Okay, Morris,
Perhaps
let me see if we may have any last minute questions coming in, but let me just share something really quick right now. We are actually running, hang on, let me share my screen. Yep. Okay. We're running a very special promotion right now for Nikkei 225 where you can stand to win air tickets to Japan if you trade 5 lots of the SGX Nikkei 225 index futures with us. And with every 5 lots traded increases your chances of winning. And you can scan the QR code or take a screenshot to learn full details. And with that, I think we have one question coming in. Right. Okay. Mary is asking which sector of the stock you will think there is an upside.
I hope I'm not muted. I think I wouldn't think that. I mean, utilities are traditionally so Nikkei itself has six. Not Nikkei. Let me think. Nikkei itself has six. Not the best categories, but let's go with those six. So semiconductor related or automobile related, I think will be a little bit of a trap. Reason being that you look at things like US Chips Act, you look at China going full speed, trying to produce their own chips. Yes, there's a lot of demand for chips all over, but the headwinds are kind of considerable. So that's without even looking at the valuations there. Uh, Financials, however, I think quite a big. I mean, so one is you're looking. It depends on your investment thesis in a sense. So one is you're looking at your tech stuff, your semiconductor manufacturers, right? There's further room to run, which means valuations wise, they're still undervalued. But I think geopolitically speaking, right, it's a bit risky. Then there's financials, which to me are actually quite heavily, or rather valued fairly, or even a little bit overvalued in that sense. But these guys are the ones who will benefit in a rising rates environment. And I do think there needs to be a rising rates environment, at least for Japan. Uh, so up to me at least, right, where I put it is at least I'm very certain where I wouldn't be so convinced by, which is those more attractive Chinese stocks. You're talking about Kias, you're talking about those kind of semiconductor guys. But I'll be looking a bit more at financials. So anything from your banks to related financial institutions. Yeah. So at least that's the sector view. Is that one more question? I can't see the full thing.
Yes, there is one more question. How does Japan stopping buying of, I'm not sure, this is JGN, affects the USD, yen, and the Asia stock market?
I'm trying to open up this up bigger to see it.
You can undock the
How does
questions box.
Japan stop? Oh, okay, I see it. How does Japan stopping buying of JGBs affect the USD, yen, and Asia stock market? Right. So how it works is that why did they buy JGBs? They bought JGBs out to 10 years. So your yield curve, right, is your 1 to 30s, and then the yield curve looks like this. So lowest interest rate to highest interest rate, 1s to 30s. So it looks like that, right? So it's your healthy yield curve. Japan's yield curve looks like this. It's flat. It's flat if you like, and then from 10s onwards it goes up. At least that was how it was like under the zero interest rate regime. So what I'm trying to get at is they used to buy JGBs out to 10s, and a big reason for that is they want interest rates for everyone else to be as low as possible. And technically, if
Sorry, Maurice, we lost you. I think we're having some tech issues currently. Hang on. Sorry, give us a moment while we sort out this technical issue.
How now?
Yes, got you. Can.
Okay, great. What was I saying? If I was a Japanese company, so I was saying is if because Bank of Japan has been buying bonds, and then it keeps. Firstly, the first implication of that is, to me, dollar yen will go down. Yes, if it's more of that, dollar yen will go down. And one of the dynamics at play is, for instance, if I'm a Japanese company, I suddenly now have access to low interest loans for no reason. And everybody's going to be doing this. They're going to borrow money, they're going to produce more, they're going to buy more, consume more, whatever it is. Every economy hits a cap on how much you can produce, how much you can consume. What happens then? You're going to take that money, you're going to speculate. And the thing is, your company, you're sitting, your finance guy comes to you and he says, look, with this much cash we're sitting on, if there's an attractive new shiny object for your company to invest in to make sure it's not sitting in the bank at 0% interest, you're going to invest in it. What do I mean? You're going to see a bubble. You're going to see a bubble in other stocks. You're going to see a bubble in property. You're going to see a bubble in what? And that drives more strength in yen-denominated assets. So you're talking about implications for if you were buying JGBs and then you keep interest rates low, you expect to see one of the dynamics is actually on dollar yen go lower. The opposite, if you say stopping is right, you expect dollar yen to go higher lah. But obviously now the thing is, I don't think it's really much of a factor, and a big reason for that is you're not really seeing a bubble, even though there's been negative interest rates, which is in a way it's a bit of a mystery that I don't think there's that satisfactory an explanation. How can you have negative interest rates or even zero interest rates and then have an environment where inflation is still so weak? In that sense, there's a case, perhaps I don't think it's enough time to explain it, but there's a case to say that actually Bank of Japan's negative interest rates were as bad as high interest rates, and there's a whole dynamics behind it. So to get the answer, you're gonna have a look into the dynamics. So I've outlined one of the dynamics to you, which is what do companies choose to do when they have low rates, which is JGB buying. As for Asia stocks, I don't think there's that much of an implication on that. Investment teams wise, they don't really look at, say, Asian stocks, but the Asian debt, now that's a different matter, or Asia Pacific debt, that's a whole other matter. So for instance, right, Japan, a Bank of Japan, when it buys JGBs, it does what we call, it kind of affects the function of the market. It's crowding out effect. It's kind of, artificial demand, anything you like to call it. So what happens then is that right now you're actually seeing Bank of Japan sitting on more than half, 60% of most tenors of the JGBs that they're buying. What that means is, there's an auction that comes out, the Bank of Japan comes in and just buys most of the bonds. So it means you're guaranteed. You have guaranteed demand for the bonds, right? And if you are an investor, and what does the Bank of Japan do with it? They don't trade it; they keep it. So if you're an investor, what do you see? You see low liquidity. You see kind of yields not being where markets are determining it, which means you don't know what the true interest rate for 1 year to 10 years and beyond are, right? So you don't participate in that market. And what do you do instead? You buy other people's bonds. You buy, say, Australian bonds. The Japanese are big holders of Australian bonds, or some European bonds, things like that. So I think there's more uh, investment teams there. As for stocks wise, right, the clear preference is still outside of Asia for Japanese stocks, for Japanese investors in a sense, for the larger ones in particular. Yeah. So I hope that goes some way to answering that question. Okay. Oh, okay. Okay, I see the questions now. Uh, Quick one. Do I think dollar yen's gonna break 160? I suppose you mean more conclusively or decisively in that sense. I think all signs are pointing to yes. My view is if I were to take a firm stand and say yes, it would. Highly likely. Please don't trade based on this. Obviously, it wouldn't. But why I base that view on is I think there's this perception that Bank of Japan is actually stalling for time with their recent moves, and a lot of it, obviously, a lot of it hinges around the Bank of Japan, right? So what I mean by stalling for time, right now the economic data clearly doesn't support further tightening of monetary policy. So in my opinion, and really this is just my opinion, what's the rush, right? Big reason for the rush is actually dollar yen. But at the same time, you cannot tighten monetary policy too quickly because the economy clearly doesn't, as you can see, the whole suite of economic data we're looking at, everything is either marginal, it marginally justifies tightening of monetary policy, which is good for the yen, which means dollar yen go down, but it's really on the wire. And a lot of it, if you tighten monetary policy and weaken the economy, it's going to immediately make it worse, which means that, right now it's on the margins, and then you tighten monetary policy, then it won't be on the margins anymore. At least that's the fear. I won't say it will play out clearly like that. So there needs to be more convincing domestic catalysts for the data-wise. Really give the urgency for them to raise rates. As it stands now, I think the number one convincing thing for a lot of market participants is actually uh, Bank of Japan may tweak interest rates higher out of consideration for the yen, which by law they are not allowed to do so, but they circumvent this by saying that it's going to impact imported inflation. So there's not enough convincing reasons to actually stop dollar yen from going higher. That's all I'm saying. And big part of that is considerations out of the Bank of Japan. July-wise, I don't think they're gonna move, or not say they're gonna move. I think they might, but August may be a better one, better meeting to watch to me at least because they're gonna get a little bit more economic data then. That being said, if markets kind of lose their nerve or they think that the Bank of Japan is going to lose their nerve, it's really about playing chicken with that level. If they think that uh, if they think that the Bank of Japan isn't going to step in because just because of the yen. So it's quite an interesting one. I don't think there's really any convincing factors to say that there's going to be a meaningful reversal in yen weakness, which is to say dollar yen go down. It's a bit suspicious, I'd say. Uh, will it affect? Okay, there's a question here. Will it affect interests, loans, and how it affects funds? Uh, Interest for loans. Uh, I'm not too sure I understand the question. So what I'm getting here is that how will interest rates for local domestic loans be like? You can type the second question there, but interest rates wise in Japan, I'd say they have been skewed lower because of yield curve control. Like I said, ones to tens was essentially flat for at least a period of negative rates. Now they're going up quite sharply, but nothing as sharp as you see in the US, which means yield spread is still wide. Corporate debt wise, right, there are some concerns about the impact of higher interest rates on things like your demand for credit as well as your delinquencies. But a move from 0% to 1% is not going to get anyone out of bed. Let's put it that way. It's yeah, I mean, if the the fundamentals of the economy were that weak in a sense of businesses going out bust because of 0% and 1%, then they got other problems to worry about. But that being said, the true concern is, I think with your question as well, is what if it goes even higher? To me it's pretty interesting. I don't have an answer, and big reason for that is observation I saw in JGB land, so to speak. So as part of my job, I have to look at directly related stuff, which is Bank of Japan, what do they say, dollar yen, economic data, whatever it is. On the fringe, I also do look at other developments which are perhaps relevant. And one of them was actually that there's a lot of funds, a lot of trading houses out there that wants to be able to trade JGBs. So they got to structure derivatives, futures, all that, and they got to structure it in a way that makes sense for a period where interest rates were positive. And then a lot of them actually realized that the last time interest rates were positive, meaningfully so, talking about 20, 30 years ago, and people with that experience have actually retired. So the headlines and a lot of buzz was actually on, hey, this guy got brought out of retirement and they're paying him how much? That guy got brought out of retirement, they're paying him how much? So I think my takeaway from that, at least, so again, I don't have an answer to that, but my takeaway from that is Japan's entering a little bit of a new again, uncharted territory where many people are very unfamiliar about what it means. So one of them is the financial literacy point I brought up earlier. The other point is actually, what does it mean to exist as a business or a financier in a period of positive rates? Are there any blind spots? Am I missing anything out? I think there are plenty. There's probably plenty of blind spots. Already with rates going such a snail's pace higher, right? You're already seeing a lot of interesting observations, and one of them being the really headlines about people being hired by funds. That was pretty interesting to me. I think that is all the questions I see.
Yep. I think that's all the questions we have for tonight. Thanks, Mooris, for the very informative session, and thank you everyone for your time tuning into this webinar tonight. We'll be sending everyone a link to today's webinar recording so you can watch it again if you'd like to. And if you have any other questions for Mooris, you can also send it to us via the survey that will pop up when we end this webinar later. Yeah, so that's all for today. Thanks again and have a good night.
Thanks, guys.